trend lines. A trend line is a line that connects two or more price points that extend into the future to confirm and validate a trend. So the principles of support and resistance also apply to trend lines. Here we have an example of the uptrend line represented by this black line. So to draw the uptrend line, you want to connect at least two intermittent lows, where the second intermittent low is higher than the first one. So for example, here we have an intermittent low. We have a second intermittent low here. But this second intermittent low is higher than the first one. Here we have another intermittent low. Here's another one. And here's another one. So we connect a line through the intermittent lows to get the uptrend line. So the uptrend line acts as support. So it represents that demand is increasing even though the prices are also going up. So the uptrend remains into effect as long as prices remain above the uptrend line. So for example, if prices break underneath the uptrend line, then we are no longer in an uptrend. So this is the key, is that the uptrend remains as long as prices remain above the uptrend line. If prices break underneath the uptrend line, then we are no longer in an uptrend. If prices break underneath the uptrend line, it means that there is a decrease in demand. So that gives us an alert. So to summarize, an uptrend line is formed by connecting two intermittent low price points, where the first point is lower than the second, creating an upward sloping line. An upward sloping line indicates increasing net demand, so demand is increasing even though prices are moving higher. An uptrend line acts as support. An uptrend is valid as long as prices remain above the uptrend line. So prices breaking below the uptrend line is an alert of decreasing demand and that there may be a reversal in trend. Conversely, a downtrend line is formed by connecting two intermittent high price points, where the first point is higher than the second, creating a downward sloping line. A downward sloping line indicates increasing net supply. So selling pressure is increasing even though prices are moving lower. A downtrend line acts as resistance. A downtrend is valid as long as prices remain below the downtrend line, and prices breaking above the downtrend line is an alert of decreasing selling pressure and that there may be a reversal in trend. Here we have an example of the downtrend line represented by this black line. So again, to draw the downtrend line, you connect at least two intermittent highs. So we have an intermittent high here. Here we have another intermittent high. Here's another one. So we draw a line through these intermittent highs to get the downtrend line. Now notice that the downtrend line always appears at the top, whereas an uptrend line, the line appears on the bottom of the prices. So the downtrend line represents resistance. Now notice here, prices broke above the downtrend line. So as long as prices remain below the downtrend line, the downtrend remains in effect. But here we have prices that has broken above the downtrend line, and this gives us an alert that there is a decrease in selling pressure. The price points that form the trend line should be equally spaced. It takes a minimum of 2 points to form the trend line. In general, to confirm that a trend line is truly valid, it must be composed of at least 3 points. The more points that form the trend line, the more valid it is. As the steepness of the trend line increases, the less valid the trend line becomes. Prices of a steep trend line advances very sharply. We know that sharp increases in prices cannot be sustained for long periods of time.